Good afternoon. This is Danielle Parker with the Preservation Alliance of West Virginia. Thank you for joining us today. We will be giving the presentation with William Fiederlein of the National Trust Community Investment Corporation. William is an acquisitions manager with NTCIC. He's based in the DC office. In this role, William is responsible for sourcing and underwriting historic and new markets tax credits across the country. Since joining NTCIC in 2016, William has been responsible for closing over $120 million of equity investments in tax credit transactions on behalf of several major U.S. financial institutions, totaling over $750 million in development costs. Sample transactions ranged from a small business incubator in Buffalo, New York, to a nationally recognized pediatric health and research center in Washington, D.C. Prior to joining NTCIC, William worked for a boutique tax credit syndication and consulting firm, where he assisted project sponsors in securing equity through various federal and state tax credit programs. So William will be doing the presentation today, and if you would like to, you can submit any kind of questions. There's a question panel, and we'll be receiving those and fielding those questions. You can also send things through the chat if you would like to do that. And I will give it over to William. Thank you.
Awesome. Thank you, Danielle. Can you hear me okay? Everything sound good?
Yes, my end.
Okay, great. Well, thanks everyone for joining today. I know obviously we're joining under a little bit different circumstances than we thought, unable to do it in person, but nevertheless, got some great information prepared for you today to learn a little bit more about how do you utilize historic tax credits and new markets tax credits in paying for preservation projects. So who is NTCIC? So NTCIC, National Trust Community Investment Corporation, we're a subsidiary of the National Trust for Historic Preservation, which is the country's biggest nonprofit devoted to saving historic structures. We finance sustainable economic development projects in communities nationwide, primarily by providing tax credit syndication services, usually focused on historic tax credits, federal new markets tax credits, and solar tax credits, providing technical assistance to developers and sponsors of innovation projects. And we're also big in the advocacy side, fighting for the permanency and improvement on historic tax credits, new market tax credits in Congress, at the state and local. And we primarily work in low-income communities. But what does low-income communities mean? When I say low-income community, or LIC, it's technically defined as any census tract that meets one of the following criteria. It has either a poverty rate that is at least equal to 20%, or median family income for the census tract does not exceed 80% of area median family income. So like I mentioned before, we're a subsidiary of the National Trust. We were formed in 2000, our 20th anniversary is this year. We were formed to take advantage of the federal new markets tax credit program. I'm going to get into that in a little bit. So what you have to remember is important is that NTCIC is a tax credit syndicator. So what that means is that we provide and connect private investors to provide capital to developers who are rehabilitating historic buildings, again, typically through the federal historic tax credit program and the new markets tax credit program. And we're also a qualified community development entity, or a CDE. And this is a little bit more important later on when we discuss the new markets program, but the CDFI fund only awards new markets tax credits to CDEs. So as a tax credit syndicator, that essentially means that we're not necessarily a middleman or a broker, but our job is to work on behalf of investors such as banks and insurance companies who have large tax liability to go out and find tax credit investment opportunities for them, and at the same time provide developers with this capital. So what is a tax credit? What are they? How do you get them? How do you use them? So a tax credit is similar, it's different from a tax deduction. So while a tax deduction reduces your amount of income that's subject to tax, tax credit is a dollar for dollar reduction in the amount of tax that you pay. From a policy perspective, tax credits are designed to encourage certain types of investment and development that are considered beneficial to the economy, the environment, or to further any other purpose that the government deems important. And like I mentioned before, they reduce the amount of income tax dollar for dollar that individuals or companies owe to federal and state governments. Subsequently, investors with a large tax liability want the opportunity to buy or invest in these credits to lower their taxes. So think large banks, insurance companies, organizations that have significant tax bills. Now, from a project perspective, historic restoration projects, which are prohibitively expensive to begin with, need access to inexpensive capital. And that's why the historic tax credit was created, to help incentivize downtown development. And tax credit syndicators, groups like NTCIC, help connect investors with projects that qualify for these tax credits. So I'm going to talk a little bit, well, I'm actually going to talk today mostly on historic and new markets, but there's a couple other different types of tax credits as well. But at the federal level, you have the historic tax credit, obviously encourages the rehabilitation of historic buildings. You have the federal new markets tax credit, which provides an incentive for investment in low-income communities. You have the solar tax credit, or the investment tax credit, which provides an incentive for installing renewable energy systems. And you have the low-income housing tax credit, which is used to finance construction or the rehabilitation of affordable rental housing. But today's presentation is just going to focus on the first two. And it's important to remember that not all credits are created equal. They each have their own policies and procedures that you have to follow for qualification. But these are the ones I'm today. So the federal historic tax credit was enacted in 1976. There's also 35 state programs. We're going to talk about West Virginia's today. At the federal level, it's administered by the National Park Service and the Technical Preservation Services Division. And the credit is earned by the developer that incurs qualified rehabilitation expenses. So I'm going to get into that in a little bit, but what that means is if you incur qualified rehabilitation expenses, then you're going to generate the credits. It's a by right credit. And it's a 20% tax credit for a single year or a 5-year period with a 5-year compliance and recapture period following completion of the project. So 20% credit. If you do a $10 million project, it's a $2 million credit. And then we're also going to talk a little bit about the West Virginia State Historic Tax Credit today. Again, obviously created to encourage redevelopment of historic buildings. This program was enacted in the late 90s and enhanced a few years ago in 2017. At the state level, the credit is administered by the West Virginia SHPO, and this credit is also earned by the developer for qualified rehab expenses. There's a few different differences between the federal program and the state program. For example, there's no cap at the federal level, but at the state level, credits cannot exceed $10 million per project. And it's a 25% credit that's taken in a single year with a 5-year compliance or recapture period. So as the federal credit was 20%, the state credit here is 25%. So significant more subsidy is available at the state level. And yes, you can combine those credits. And the amount of total credits in a given year is capped at 30 million statewide that gets allocated amongst all projects. And there's a 5 million set aside for projects generating less than 500K or 500,000 of West Virginia historic credits. And then let's talk about the Federal New Markets Tax Credit Program, the NMTC. So this program is designed to encourage investment in low-income communities. It's really been active since 2003, although it was enacted a few years earlier. There's also 14 state-level new market tax credit programs currently across the country. This one's administered by the CDFI Fund, which is an agency of the Treasury, and the credits are awarded only to CDEs, like groups like NTCIC, Community Development Entities. They get the authority to allocate credits to third-party investors from the government. So that's a key difference there between the federal historic and the federal new markets. Where the historic is by right, you follow the steps, you will generate the credits. The new markets is a competitive credit where you have to attract allocation from a CDE. And the new markets credit itself is a 39% credit, which is taken over a 7-year compliance and recapture period. So 2 years longer than the historic tax credit. So let's first talk about historic tax credits. What are they? How do you get them? And what can they do? The history of the historic tax credits. So the National Historic Preservation Act of 1960 authorized the National Register of Historic Places. So the National Register coordinates and supports public and private efforts to identify, evaluate, and protect America's historic and archaeological resources. Now, in order to qualify for the historic tax credit, the building has to either be on the National Register of Historic Places or a contributing building to a National Register district. We're going to get into that in a little bit. But the HTC itself, the tax credit, was enacted in 1976 to preserve and rehabilitate historically significant properties. It became a permanent part of the tax code in 1986 under the old tax reform. And then a few years ago, you might remember there was a new tax bill that was passed, the Tax Cuts and Job Act, and that the historic tax credit was saved from being eliminated during that tax reform process. And there were some changes made to the program, most notably that there used to be a 10% credit for non-historic buildings that were built prior to 1936. That went away, so that program does not exist anymore. And the credit is still a 20% tax credit, but now you have to claim it in 5 equal installments as the investor, whereas you used to be able to claim it in the year the building that's placed in service. Now, from a developer's perspective, what that means is that the credit isn't worth as much to a third-party investor because of the time value of money, right? The credit is going to be delivered in 5 years, over 5 years, instead of one time pricing a little bit. But it's good that it's still around and that it's a permanent part of the tax code. So it's not something that is up for consideration every year by Congress. It's a permanent part of the code. So as I was saying here, there's two types, after 2017, there's the federal historic tax credit, which is a 20% credit for certified historic structures, which means buildings listed on the National Register of Historic Places or buildings that contribute to a National Register historic district. Then you have state historic credits. There's 35 of them across the country. Like I mentioned before, West Virginia can pay 10% credit, and you can combine these two together. At the federal level, the preservation aspects are jointly administered by the Park Service and the SHPOs, and the tax aspects of it are administered by the IRS. So how do they work? So to generate historic tax credits, property owners or developers must undertake the substantial rehabilitation of a certified historic structure with an eligible end use. So am I eligible? 1, is my building, it must be a certified historic structure. And a certified historic structure is a defined term, meaning that it's individually listed on the National Register or it's a contributing building in the National Register Historic District. And 2, projects must be a certified rehabilitation, which means that your renovation adheres to the Secretary of the Interior standards for historic rehabilitation. There's an application process around that we're going to get to in a little bit. So am I eligible? The property must be income producing. So that's important to remember because owner-occupied residences do not count. So if you live in a National Register listed house, you can't claim a federal credit for any renovations that occur there. Like if you do your bathroom, unfortunately, you can't get credits against that. But if it's income producing, such as an apartment, a hotel, office, retail, a theater, then you can qualify for the historic. It must be a substantial rehabilitation, which means that you must either 1, spend in excess of $5,000, or 2, the adjusted basis of the building. And I think I'm going to get into the adjusted basis calculation on the next slide. But the reason, and you have to do that within 2 years. But the reason why the substantial rehab test was instituted is because the congressional intent, they didn't want you to just renovate 2 floors of a historic skyscraper and be able to claim credits against that. They wanted it to be only for substantial rehabilitations. And your adjusted basis means the purchase price of the property, what you paid, less the land or less the cost of the purchase attributable to land, less any depreciation you've taken against it, plus the cost of any improvements you've made since the initial purchase. Now, this is kind of getting in the weeds a little bit. Most of the projects that we work with are spending well in excess of the adjusted basis of the building because oftentimes acquisition costs are relatively low for the abandoned buildings, and 2, the renovation costs are generally high. So usually there's not a ton of problems with qualifying for the substantial rehab test. And then, like I mentioned before, to qualify for certification, developers must complete a 3-part application that is approved by the state SHPO and the MPS. So how does this process work? I should say, before I describe this process, oftentimes people engage an architectural historian or a preservation consultant that has familiarity with tax credit projects and the Secretary of the Interior's standards for historic It's critically important that you follow these plans as they are set out and approved, because that's what will qualify you for the credit when you're done. And any deviations from there that are not approved by the Park Service or the SHPO can result in the renovation being disqualified. So it's critical that you have approved plans, and it's critical that you stick to those plans in order for the tax credits, to have good credits and for the investor to be able to claim them. So in that application process, it's a 3-part process. Part 1 confirms the building is historic. So that means it's either 1, individually listed on the National Register, or 2, a contributing building to a National Register historic district. Part 2 describes the condition of the building and the planned rehab work. And the proposed work has to be based upon the Secretary of the Interior standards for rehabilitation. So this is the part where you're going to take your plans and specs and go through with your preservation consultant, submit them to the SHPO. First, the SHPO reviews them, provides their approval or any comments. Then it goes on to the Park Service. This usually takes about 30 days to review and approve, or approve with conditions, your rehabilitation work. And your Part 3 is submitted after the project is complete. So after the project's done and you followed the plans that were approved in the Part 2, you essentially submit pictures, description of the work that was done, and the Park Service, so it goes to the SHPO, they review and approve. Then it goes to the Park Service, they review and approve. And then that's when that's technically when the HTC credits are considered awarded and final at that point when you have a Part 3. Now, technically, you can claim the credits the day the building is in service. So say you place in service 31st, but you didn't end up getting your Part 3 until March of 2021. So using this year as an example, that's okay. You still have good 2020 credits in that instance because you can claim them technically before you have a Part 3. They're just not official until the Part 3 approval comes in. So what are QREs? So these are the eligible.
William, I'm sorry to interrupt you. We have a question that came in about that slide. It is, when does the federal historic tax credit investment of 20% need to be made when a project is already in service?
Okay, so I see this. When does the federal historic investment of 20% need to be made when a project is already in service? So if a project is already in service, that brings up a special set of rules called well, let me ask another question. It depends on a few things. If it's going to be rehabbed again, it's part of a rolling rehab where it was never taken out of service. That creates some different rules. But if you've already undertaken a substantial rehabilitation of the building and there's no more work planned, and the investor was not in the deal prior to placement in service, that can cause some issues around qualifying for the credits. So I see that question came from Heather. I appreciate that question. Heather, I'm happy to follow up with you offline, specifically about this instance and catch up. Contact information, or it's included as part of this presentation for sure. So I'm happy to catch up with you offline afterwards. But typically, the investor has to be in the deal prior to the project finishing rehabilitation. All right. Great. Nope. Interrupting me. I didn't notice that a question came in. So if anything else comes in, please do. All right. All right. So what are QREs? These are the eligible costs that are used to calculate the historic tax credit. So QREs are qualified rehabilitation expenditures. So what counts? Your hard costs, demo, construction, electrical, plumbing, HVAC, et cetera, that are incurred in the historic rehabilitation. Certain soft costs are going to apply, such as fees for your architect, any project management, insurance, construction period interest on your construction loan, taxes that you're paid during the construction period, any application fees, things of that nature all qualify for the credits. Typically, it's described as any costs that are attributed to a capital account and will be depreciated once the project is done. Now, what doesn't count? Acquisition costs, so the costs that you pay for the building, are not eligible. Demolition costs of any historic, now when I said demo before, I meant demo of the existing interior walls of the building, things of that nature. Demo of any historic buildings on site or pieces of that would not count. Costs attributable to leasing, marketing, any new construction that's occurring on site because it's not a historic building, and some non-historic construction. So say you were putting an addition on a historic building, typically that would not, the cost attributed to that addition should not count. All right, let's see. All right, and then like I mentioned before, the tax credit is 20% of QRE. So if a project is eligible, then the building owner is able to attract capital from investors in exchange for these credits. The value of historic credits, like I mentioned before, QRE times 20% is the credit. Now, third-party investors will typically pay less than $1 per credit to realize the benefit from these credits. So for projects that are generating greater than 10 million of eligible expenditures, usually you're going to see pricing in the low to mid 80 cents on the dollar. And this is just referring to the federal historic credits. Now on the projects that are smaller than that, somewhere, so 10 million, less than 10 million in QREs, 2 million in credits, typically going to see pricing low 80s or lower. It really just depends. From my perspective, we work from a national perspective across the country, whereas sometimes if you're working with like a local bank, things of that nature, they might be willing to pay you a better price than you would get otherwise, from a syndicator, from a group like us. And then obviously the credits times the pricing is the amount of equity that the project is able to attract. So let's talk about the compliance period. So the compliance period is a 5-year period that starts after the building is placed in service, which means it receives a certificate of occupancy. And the federal credit is earned 4% per year over 5 years. But that's not necessarily the timeline that investors will make their equity payments to the project over the development and the construction period. So our typical paying schedule is 30% at closing. So what does closing mean? It means when you close on typically it means when you close on your construction financing, you're going to close on the historic investment at the same time. Now, the closing process on the historic tax credit is very similar to closing on a commercial construction loan. There's a lot of overlap between the two requirements, where requirements for environmental diligence, title, survey, the appraisal, things of that nature are all going to drive the historic investment. But the key difference is that instead of negotiating loan docs, you're negotiating agreement, because you cannot buy and sell federal credits, which we're going to get into soon. And instead, they have to be allocated to a partner in a partnership. We're going to get into that a little bit. So once we close on this investment, we typically put in 30% of our money at closing. And then the next slug, or 45%, would come at placement in service. So as you can tell, if there's only 30% of the money in, how does a developer realize, the benefit from the credits? They'd have to bridge that money. So there's lenders out there that will bridge the credits for the receipt of they'll bridge the tax credit equity, where they will bridge receipt of those proceeds during the construction period. And then, so I mentioned 45% at placement in service. Then you have another 15% typically when the project receives their MPS Part 3 approval. So that means the project's done, it's qualified for the credits. And then usually we'll hold back about 10% or so until stabilization, which means when the project begins to generate income, because the federal historic investor is in the deal for two things. They're in it for credits, but they're also in it for cash. They want to see some type of cash upside from the project in order to generate a higher return for participating in the transaction. So that's why when I mentioned before that investors looking for an appraisal, all the other diligence, they're not just there for the credits, they're also there to participate in the operations of the project, because they're a true partner in a partnership, and they have to see some upside potential and downside risk. And then there's a 5-year compliance period. So once the project is placed in service, this is the period in which credits are subject to recapture. Recapture means that you can't, things that would trigger a recapture include material alterations to the building. So you have a historic building and throwing a big addition on top of it. You can't transfer ownership via sale or foreclosure, so you can't sell the building. And also, recapture could also be triggered by a material loss, so if the building were destroyed. There's a 5-year burn-off period where the amount of credit subject to recapture decreases by 20% each year for the 5-year compliance period. That's also the investment horizon for the federal historic investor. So they'll be in the deal for 5 years. When I say in the deal, I'll describe that in a little bit. But they're participating in the transaction for 5 years post completion. They want to see the cash return that they're underwriting, and then once they receive the cash that they anticipated to receive at closing, then that's when they have an option to exit the deal and put their interest back to the sponsor. Now, recapture is extremely rare. I do want to mention that. I think according to data, I believe the recapture rate is somewhere less than 1% of all projects. And I think there's been about $1 billion in credits issued a year for the past 20 years or so. So it's extremely rare.
William, we have another question that came in about if all parts of the restoration have to be approved to qualify. For instance, if siding is not going to be refinished but new installed, does that make the entire project ineligible for approval?
So when you submit your application, you're submitting it in the entirety. So the plans need to contemplate, or the plans and specs that are submitted need to contemplate the entirety of the renovation. So then it would be up to the SHPO and the MPS to confirm that either what's being done, or if it's not going to be refinished, does the new one installed, does it match the historic character of the building? So it shouldn't make the entire project ineligible, because the project itself should be evaluated in its entirety at the time when you submit the application. All right. All right, so monetizing the federal HTC. Now, I don't want to scare anyone with this slide, but you can't buy and sell federal tax credits currently, the way the law is written. You have to allocate them to a partner in a partnership. So I'm going to kind of explain here what's going on. So if you look at the left side of your screen, your master landlord, your developer, this is the entity that's going to undertake the renovation and generate the credits. So they're going to ones that are going to borrow the construction loan, spend the money, and incur the qualified costs. They're the ones that's paying the contractor and paying everything else, and handling construction. So like I mentioned before, they're the borrower on the loan, which is the top box that you see. And then you see below the managing member. That's the entity that controls the developer partnership. So you have a developer, and then you'd create an affiliate entity, an LLC specific to a given project that's going to undertake the renovation. Now, how does the money make its way to the developer to allow for, to pay for construction costs, right? How does the federal historic equity come in? So what happens is there's a master lease that's put in place. So we have master landlord, which is 90% owned by the managing member and 10% owned by the master tenant. So master landlord is the developer, then you have master tenant. So what happens is at closing, this master lease is put in place. There's a partnership that's negotiated. So these master tenant, master landlords are LLCs that have operating agreements that get negotiated between managing member, the developer, and the federal historic investor. So there's a lease that's put in place at closing, and via that lease and via the operating agreements, the master tenant is going to own a share of the landlord, and the managing member is going to own a share of both. So this lease is put in place, master tenant's created. The federal investor is going to own 99% of master tenant because credits get allocated based upon ownership, and they want 99% of the credits. You can't have 100%. Whereas the 1% member is going to be the developer that's going to operate the project. So this entity is created, it's negotiated. That's going to contain the terms of the investment. What price are they paying per credit? What are the installments that they need to hit in order to pay for the credits? In order to contribute equity for the credits? What installments does the developer need to hit? What are the do's and can't do's of the developer partnership under the master tenant operating agreement? So this is the most negotiated document between the two, because this governs the relationship between the federal historic investor and the managing member, who's again, managing member, developer. I can use it interchangeably. So the master tenant then, as the project progresses, or they collect rent. So once it's in service, that's the entity that leases the individual apartments or commercial square footage to the tenants, who pay rent to the master tenant. So the tenant collects the money. Now they make that lease payment to the developer, which is how you get the money up to pay the lender for the construction loan. And then any residual gets paid to the managing member, who owns 90% of the entity, so that helps the developer protect their cash flow. Now, this is a very kind of rudimentary approach to this. Obviously, it's very complex. It's a federal program, that has to pass muster with the IRS, things of that nature. So it's very complicated from that aspect. But it's important to remember that you can't just buy and sell the credits. This partnership has to be set up. So looking at this legal structure, you're probably thinking, well, how do I do that? There's attorneys that all they do is they focus on tax credit projects. There's accountants that only do that. And the tricky part is about smaller deals is that there's a lot of fixed costs associated with this. You have to pay attorneys, accountants, things of that nature in order to monetize the credit. So it makes it tricky to monetize the federal historic credits at a small level compared to when you would do it, on a bigger project that's more easily able to absorb these credits. Absorb these transaction costs. But when that lease is put in place, so coming back to the federal investor, with this master lease is put in place, under the Internal Revenue Code, you're allowed to pass through the federal historic tax credits to a long-term lessee. So we talked about the lease being put in place at closing. The developer here on the left side generates the credits. They pass through those credits to master tenant. Tenant is owned 99% by investor. They get to claim them in exchange for their ability to claim the credits. They contribute equity to the tenant. The tenant has an ownership stake in the master landlord. So then they make a capital contribution to the landlord to move that money up there to pay for construction costs. That's about the most basic way to explain what's going on here. So let me check and see if we got any questions.
Yeah, we do have one more that just came in.
Perfect. Okay, so the question is, does the HTC code dictate the equity value of the members, or can those equity values vary according to the operating agreement? So that's a good question. So the tax code says that credits have to be allocated based upon ownership. So that's why you have this master tenant entity that's owned 99% by the federal historic investor and 1% by the managing member. So that's because the federal investor is going to want 99% of the credits. Now that's how it is in a lot of transactions, but say they only had a need for 50% of the credits being generated, and the developer partnership had a need for the credits as well to offset gain from other transactions that they do. That's perfectly fine. You could split it 50-50 too. There's no hard and fast rule on that. It's just that the credits must follow in accordance with, or the amount of credits that get allocated must follow in accordance with ownership percentages. And I think, but then the amount of equity coming in also does not necessarily need to mirror 99.1. So this is kind of getting technical here, but obviously the federal investor is going to contribute 99%. The managing member is going to put in 1%. It doesn't have to necessarily tie, like, if I put in $1 million and somebody else doesn't have to put in 1% of $1 million. But that's kind of getting in the weeds a little bit. But I'll hold on this slide for a second, see if any other additional questions come in, because I know this one is a popular slide. But again, if anyone has any specific questions on this type of stuff, feel free to reach out afterwards if it's easier to just talk through them, because sometimes these things can be complicated. All right, let's move on here. So the state of West Virginia historic tax credit. So this might be of particular interest to the audience today. The state of West Virginia offers a companion 25% historic tax credit that can be coupled with the federal historic tax credit. And the amount of the credit is capped at $10 million per project, statewide at $30 million in credits allocated annually. And no less than $5 million of these credits shall be set aside for projects generating less than $500,000. Now the qualification process is going to follow the same procedure as the federal HTC, but they can also be monetized through the third party. So now this monetization process is a hell of a lot simpler, sorry my language there, than the federal historic process, because this credit is able to be bought and sold, unlike federal historic credits. So whereas I described that partnership agreement before, where you have to allocate, get attorneys and accountants involved. Apologies to any attorneys and accountants on the phone, or sorry, on the call. I'm not trying to put you down. But the projects, it makes it a lot easier when the credits are certificated. Now it's typically in the high 80s. So the way this works is once the project gets its Part 3 approval, then I'm going to get a certificate that says I, William, generate, let's say I did a $10 million project. It's going to say I, William, have a credit here for $2.5 million because it's 25% credit. And what I can do is I can take that piece of paper and I can sell it to Danielle, who's our host here. And I can say, hey, Danielle, you can buy this. We can just do a straightforward purchase agreement of, say, 90 cents on the dollar. You pay me for the credits. You take the credits. You claim them on your state tax return. I get the money for the project. It's a lot simpler. That's very common in a lot of state programs. Some states it's certificated. Some states it's allocated amongst partners in a partnership similar to the federal level. But in West Virginia, it is a straightforward purchase and sale. So that makes things very straightforward from that perspective, and monetizing it makes it easier. And then here's a couple of statistics I pulled on the use of the credit in West Virginia. You'll note that a total of 117 projects here have been certified by the National Park Service until 2019. So this is as of 2019, with 44 million in credits generated, between 2002 and 2019. Estimated total development costs of around 255 million. So you'll see here, it looks like Charleston leads the way with 19, then you've got Wheeling with 18, Huntington 17, and Martinsburg's had 7. We actually did a project in Martinsburg, which I'm going to get to in a little bit here at the end. But if you'd like some more information about use of the historic tax credit in West Virginia or any advocacy efforts, you'll see contact information there for Shaw Sprague, Patrick Robertson, and Mike Phillips, who's a colleague of mine. Click through this link here, forum.savingplaces. I think the slides will be available afterwards, and you can check this out. All right, so historic tax credits and nonprofits. I wanted to touch on this just because it's important to understand that nonprofits can realize the benefits from the historic tax credit. There's several special considerations that exist, and this gets a little complicated, so I apologize in advance because it is very nuanced. But it's important to remember, and a key takeaway here is that nonprofits such as like Friends of the Local Theater, LLC, can benefit from historic tax credits. There's just certain structuring considerations that you need to take into account to utilize those credits. Now, there's certain things like public schools, for example, cannot qualify for the federal historic credit because they're nonprofit before. Then if you renovated a historic school, after you renovated it, it would still be occupied by a public school. So that's not going to qualify. But there's certain considerations where, say, a nonprofit bought a building that they did not occupy before, and then they renovated it. As long as you don't violate any of these tax exempt use rules I'm going to get into, you can qualify. Now, again, this is a little technical and complicated, but it's just important to remember that it is doable, and to reach out to an expert if you think you're going to be in this situation. So the basics of tax exempt use property. In general, historic tax credits are available to taxpayers that are liable for federal income tax. So individuals, businesses, and 501c3s are exempt from federal income tax generally and do not directly benefit from HTCs. So 501c3 participation in the ownership or leasing of a project can also jeopardize those credits. Tax exempt entities, when I say that, federal, state, local governments, any political subdivision thereof, any organization that is exempt from federal income tax under the Internal Revenue Code, foreign persons or entities, or any Native American tribal government. So those are tax exempt. But can tax exempt still use HTCs? Yes, they can. It just requires careful structuring considerations, which I think I've said about 5 times now. But that's why it's important, because you don't want to mess anything up here so you have good credits. So property is treated as tax exempt use property if either 1, more than 50% of the property is leased to a tax exempt entity under a disqualified lease, or 2, the tax exempt entity is a partner in a partnership that owns property and the tax exempt entity is not receiving qualified allocations of partnership items under the operating agreement. And then any expenditure allocable to tax exempt use is not included in calculating QREs or an HTC basis and will thus not generate HTCs. So you don't want to have any of the costs allocated to tax exempt use. Now this, again, it's a lot of text here, so I'll just hit on the highlights. But the disqualified lease rules say for non-residential rental property leased to a tax exempt entity, and we keep saying leased because we're talking about the master lease that's put in place to the master tenant pass through the credits. Going back to this, for non-residential property leased to a tax exempt, a lease would be treated as disqualified if part or all of the property was financed with tax exempt bonds and the tax exempt lessee participated in the financing. So that means like if a city raised tax exempt bonds and ended up occupying the project, that would not count. Under the lease, there's a fixed or determinable purchase price or option to buy. So you can't have any option to buy at the end of the lease. The term is in excess of 20 years, or the lease occurs after a sale or lease of the property from such entity, and the lessee used the property before the sale, which is called a sale leaseback. Now, there's exceptions for all of these rules. The property leased for less than 3 years, and less than the greater of 1 year or 30% of the property's class life. Tax exempt use property does not include any portion of a property if it's used by the tax exempt in an unrelated trade or business. The property leased is less than 50% of the net rentable square footage of the building, so that's the most popular one that we play with. And if more than 50% of a building is leased to a tax exempt, you could still claim HTCs on the QREs incurred for the portion of the building not rented to a tax exempt. Now, again, this is kind of complicated, but just stick with me here. So nonprofit partners. If an owner has a tax exempt entity as a partner, then the property and the QRE owned by the partnership will be considered tax exempt use property to the extent of the percentage owned by that disqualifying entity. And note that pass-through entities controlled by tax-exempt partners themselves are considered tax-exempt. Now, there's an exception here. An entity controlled by a tax-exempt can elect to be taxed as a corporation and make an election called a 168H election and to not be treated as tax-exempt. So as consequence, this entity would incur unrelated business income tax from any income generated by the property. That being said, that's what allows them to monetize the historic tax credits and associated with the transaction. So here's a flow chart. I'm not going to go through all this, but it's important to refer back to if you're interested in it. Are any of the following entities involved in the lease transaction, and do these rules apply? It's kind of a good flow chart or a teaching tool to understand on when you have tax exempt use property and when you don't. But here's an example, and I think this is the most important key takeaway here. For example, let's talk about this art gallery restaurant event space. A nonprofit purchased a building for rehabilitation and operating of a restaurant, event space, and an art gallery. And this nonprofit set up a separate LLC to buy the building, which we'll call Owner LLC. So the art gallery portion of the property was leased back to the nonprofit. However, the lease was less than 50% of the net rentable space. Therefore, it was not tax exempt use property, which preserved all of the QREs. And then the managing member of the building, who is the nonprofit, a wholly owned for-profit subsidiary of the nonprofit. So that nonprofit set up two entities, really. They set up the entity that purchased the building, the owner that undertook the renovation, and then they set up a managing member, which filed this 168H election to prevent any tax-exempt use issues, because when you file that election, you're saying you want to be taxed as a corporate entity, so that prevents the tax-exempt use issues. And then here's another example of a church here. The All Saints Church was owned by a tax-exempt religious organization to the owner LLC. It was rehabilitated into apartments and released to non-related parties. The owner's managing member was a wholly owned subsidiary of the religious organization, so it was a tax-exempt. So they filed the 168H election, and then they did not have to worry about being a tax-exempt. And then none of the leases that were set up were disqualified leases, so none of those QREs were tax-exempt use property. So again, that's kind of really getting in the weeds there. So it's important to talk to experts in historic tax credits when you have nonprofits involved, nonprofit tenants, or nonprofit tenants or end users in the building, to make sure that you preserve and have good credits. But we talked at the beginning of the project, we worked on a healthcare facility in Washington, D.C. Now the entity that's going to be occupying that is entirely a nonprofit hospital system. And there's good QREs there, and it was structured as appropriate so that it would not violate the tax exempt use rules. Now they're tricky, so that's why it's important to consult an expert. So I think we're good on historic tax credits for now. I guess it looks like we've only got 15 minutes left, so let me try and go quick here through new markets, and so we'll have time for questions. So new market tax credits, what are they? How do you get them? The New Markets Program was established with support from Congress in 2000, and it's administered by the CDFI Fund. They encourage low-income investment in low-income communities by allocating federal credits to third-party investors. And these communities have traditionally had poor access to traditional debt equity capital. It can be used on all property types, including office, retail, mixed-use, healthcare, grocery stores. And for a property to be eligible, it must be located in a low-income census tract. So the CDFI Fund, and that's important, has to be in a low-income tract. The CDFI Fund only awards allocation on an annual basis to qualified CDEs who apply for an allocation of these credits. So that's important. So NTCIC is a qualified CDE. We've won 11 rounds of allocation totaling about $580 million. The key difference from the HTC, and I mentioned this before, is that the HTC is by right. You follow the steps, you're going to generate the credit, whereas the New Markets is competitive. You have to attract the allocation from a CDE and have them provide it to the project. Now, it's not permanent, but it was extended for 1 year last year, which created an additional $5 billion allocation round that's going to open this fall. And if a project is eligible for both historic and new markets, you can use them together. It's very common. It's called twinning. It's all that NTCIC does with our new markets business line. And it obviously provides more equity to the developer. So, and I'm sorry that I'm kind of rushing through this. Danielle, this ends at 1, right? Or sorry, 2?
Yeah, we have it scheduled to end at 2. Yeah.
Okay.
But it won't shut down or anything.
Perfect. Okay, great. So I apologize, folks. If you can stay with me, please do. If you can't, I totally understand. And we can have these slides posted up and made available. But in a nutshell, new markets are generated when a QEI is made into a CDE that in turn uses substantially all of the QEI to make a Kalicki and a Qualic B. Now that is a lot of acronyms and words right there. So let me just kind of describe what's going on. But when new markets are generated, when a QEI, which is a qualified equity investment, is made into a CDE. So NTCIC will set up an affiliate that gets an investment, and we contribute those dollars to a project that benefits low-income people, usually in the form of a loan, with a very friendly, flexible terms. So the credit itself is claimed in installments by the investor over the 7-year compliance period. I've got a schedule here that shows how the credits flow to 39% credit. So again, this is more from an investor perspective here on how the credits would flow based on a $10 million QEI. You know, obviously investors will pay for the amount of credits received. They don't anticipate any cash flow or upside. So unlike historic, where you're looking to share in the cash flow, new markets investors are there just for the credits. Right now, the market pricing is kind of low 80s. It's ranged from the 70s to the 90s over the life of the program. It rises and falls along with kind of the health of the US economy. But ultimately, and this is the important part, projects can expect to retain a cash subsidy of approximately 18 to 20% of the total new markets allocation that they are able to secure. So how does a CDE evaluate a project? Is it located in an eligible census tract? That means it must be in a low-income community, which means it has a poverty rate greater than 20% or area median income is less than 80% of area median income. Or it can be severely distressed, which means that it has a poverty rate of greater than 30% or AMI less than 60 or unemployment 1.5 times the national averages. So think some of the poorest neighborhoods in the country, but you'd also be surprised on what qualifies based on population. NTCIC is kind of unique in that we only do projects located in severely distressed census tract. What type of businesses will be at the project? So as a CD evaluating it, there's certain businesses that are excluded from benefiting from the new markets tax credit program. So this was written into law, but essentially you cannot use new markets for golf courses, racetracks, gambling, farming, country clubs, liquor stores, hot tub facilities, massage parlors, things of that nature. They call them quote unquote sin businesses. I'm not really sure why certain things like hot tub facilities are in there, but regardless, this is the way the law is written, and these are the projects that cannot benefit from new markets financing. Now, will the project have a residential component? New markets are intended to be for, so there is restrictions and requirements for projects that have residential units. Buildings or structures that derive 80% or more of their gross income from residential rental income are prohibited. They have to be commercial structures. And for a residential component, some of the units need to be set aside for households earning 80% or less of AMI. And then what are the anticipated community impacts? The thing that gets CDEs interested because they want to participate in the best projects. So how many construction jobs are going to be created? How many permanent jobs are going to be created? What's the quality of these jobs? What type of benefits are these jobs accessible to the low-income community? Are there going to be goods or services that are beneficial to the community, like healthcare delivered to the low-income population, or workforce development training programs, or contracts, or what's the minority involvement look like? What do the lease rates look like? Are you going to offer more flexible lease terms to nonprofits and things of that nature that really can't afford market rent in exchange for getting property? That's the kind of the legislative intent of the program there. And then you have, are there environmentally sustainable outcomes from the project? What type of community plan does this fit in? And what type of future business will this investment catalyze? So those are just some of the things that we take into consideration when we evaluate new market tax credits projects. And then what are the anticipated sources of financing besides the new market? So but for the new markets, what is the money coming in? Typically you'll have bank debt, capital campaign, grants, historic tax credit equity. Projects need to demonstrate a need for the new market tax credit, and that existing funding sources cannot fill the financing gap while achieving the community impacts. So it's gap financing. It's used to fill gaps in projects. I'm going to get to that in a little bit. But you really have to show a need for the credits. It's not like a project that pencils and is going to benefit from, that's not the type of project that CDEs want to do. It needs to be, and it also needs to be shovel ready. So do you have control of the building, status of entitlements, permits, environmental, MPS approvals in place if you're using historic tax credits? So the projects that benefit from new markets are called qualified active low income community businesses, or qualic Bs. Now there's requirements around a qualic B. They must generate revenue within 3 years. Some other rules here I've got listed. I'm not going to dive into each of these just given time, but if you're a project that is going to, if you're a developer undertaking a project in a low income community and you're going to lease it to like nonprofit tenants, then those, that would qualify as a qualic B, for example. That could qualify as long as these tests are met. Now, what is the value of the new markets to the qualic B? You get below market interest rates for 7 years, flexible financing terms, and at the exit of the transaction, now this is getting in the weeds, but the B loan or the new markets equity can be converted into qualic B equity for a nominal amount. And there's no repayment requirement on that. And then the new markets investments it's a 7-year compliance period as compared to 5 on the historic side. Risk of recapture for the full tax credits, you have to guarantee that you're going to be a qualic B, and annual community impact reporting. So how does the new markets get monetized? Now, I'll try and go through this as quick as I can, but the CDFI fund grants winning CDEs authority to allocate new markets as they see fit. So that logo right there is NTCIC's logo. So we're a CDE. We'll get an award of an allocation award from the CDFI fund. Then we have the authority to choose which projects to which we provide our allocation. What we'll do on the back end is essentially sell our new markets to a third party, the credits to a third party tax credit investor, who in exchange makes an equity contribution to the CDE or us. And then we turn around and take that money and lend it to the project. So we essentially function as a lender in this space, is the best way to describe it. Now, qualic Bs can receive a total allocation of new markets up to the dollar size of the project. So if a project can support a 10 million allocation, how do we get to a 10 million QEI when the new markets equity is only 3.2 million? Now, we're going to get into something called the leverage structure. Now, again, I hope I didn't scare anyone down on the historic diagram. This one might be even scarier, so shield your eyes. No, I'm just kidding. So you have the new markets leverage structure here, and this is how the new markets dollars make their way to a project. As you can see, there was a lot of attorneys and accountants involved in creating this program because it is quite complex. But usually what happens is here. So you look at this piggy bank at the top. This is called the investment fund. This entity is going to aggregate or serve as a funnel for the dollars that are going to generate the $10 million QEI. So you have the tax credit investor on the right-hand side. This is kind of the simple part of the math. For a 10 million QEI or 10 million allocation, they're going to get a 39% credit, so 3.9 million in credits. This assumes they're paying about 80 cents in the dollar, so that's 3.2 million of equity. So where do we come up with the remaining dollars to fund the 10 million QEI? You get something called a leverage loan, which is typically going to be a construction loan from a bank. Instead of it being made directly to the borrower, they're going to make it to this entity called the investment fund. Now, they'll lend it to the investment fund, who serves as the borrower, who then runs the money through the CDE, which is NTCIC, who turns around and puts those same, you'll see the 6.8 and 3.2 match those same dollar amounts. That gets lent to the project. So basically, look at it this way. If a project was only able to secure a 6.8 million leverage loan, and this is getting into the why on the right-hand side. So projects can typically only secure bank financing up to X% of a stabilized value, like 80% LTV. Similar to the way when you're, a person buying a house, you typically get a loan that's maybe, sometimes banks want 20% down or 10% down, so you can only get 90% LTV or loan to cost in that, or loan to value in that scenario. So where do you now, if you have a commercial building and it's only worth, let's say 6.8 million is 80% LTV, but it's going to cost you 10 million to rehab the building, where do you come up with the additional 3.2 million? That's what the new markets equity does. It helps essentially buy down the amount of debt that you need to raise in order to make a project feasible, because project costs typically well exceed value to the point that traditional equity would not make sense to invest. So, typical equity that's expensive money, which can be anywhere from like 12 to 20%, versus new markets equity, which comes with a lot of strings attached, but it's a lot cheaper money, closes that gap required to make projects feasible. Now, this is kind of confusing, so if you have any questions for me, just follow up afterwards. Now, here's one real world example. I wanted to get into this. So this is the Shenandoah building, which is in Martinsburg, West Virginia. We worked with a developer by the name of Eric Wishneff. He's based out of Arlington, Virginia, who undertook this project. This is formerly the Shenandoah Hotel, which was a luxurious 104-key boutique hotel that opened in the 20s, located in the heart of Martinsburg. I'm not sure if anyone on here is from Martinsburg, but it's right in the downtown, right when you come off the highway. It was a popular destination for tourists and celebrities. We did get one question. When do CDEs expect allocation? So the next round of allocation is supposed to be announced this summer. We don't have a specific date, but we're thinking sometime maybe late May or June, or it could drag. We just don't know. But all we've heard is that awards are still on track to be announced this summer. Now, jumping back in here, the historic building, so the Shenandoah building right here will be revitalized into 38 residential units and 16,000 square feet of commercial space. There's 10,000 square feet on the ground floor. Will house multiple tenants with a focus on small business graduating from a nearby incubator, as well as restaurant space. And the basement will also have 6,000 square feet, which could support a community or commercial retail operation or yoga studio gym. But there's jobs created associated with this, space for group businesses that grow out of the nearby incubator. Then you've got the 38 residential units, so 20% set aside for the 80% AMI. Now, this project specifically is the fourth project in our Irvin Henderson Main Street Revitalization Fund, which is focused on providing Main Street transactions with new market tax credit equity. Now, I showed all those boxes and arrows before. I think, wow, that's really complex, probably very expensive. And you can be right, but we actually have something called the Main Street Revitalization Fund, which is trying to provide tax equity and new markets and historic to smaller projects that could potentially benefit from these programs. They just might not have the technical expertise or the know-how or the relationships in order to do that. So if you're familiar with a project in your community that is a smaller deal and it looks like it could qualify for historic and new market tax credits, please reach out because I'm happy to discuss it with you and go over the options. Let's see here. So we've got, okay, so now I did want to show this actual structure in place. So I showed those arrows and diagrams before. Here is an actual example of how this is being undertaken. So let's start at the very top. See here, US Bank was the new markets investor, USBCDC. They contributed their new markets equity into this investment fund. This diagram's a little bit wrong because you'll see the new markets number is smaller than the equity, which is not accurate. I apologize for that. They put the money in there. This manager entity borrowed money and then contributed, made it to the leverage loan here. So that's that funnel or that piggy bank at the top. They made the QEI into the Main Street Fund. And then that entity turned around and made the loans to landlord, who's the entity that undertook the renovation. Then you see to the right of landlord, master tenant. That's where the historic tax credit investors coming in. Then you see above master tenant, the two subleases. Those are the entities paying the rent to the master tenant entities, so the ultimate end users and the individuals that will live there. And now this is a little bit more complicated. It's not necessarily accurately represented, but that Shenandoah Ventures below landlord, that's the entity that ended up selling the historic tax credits at the state level. So they sold them back to a state investor. Now, this is just an example of how something like this gets applied in real life. I don't expect you all to kind of take away anything from this slide. I just wanted to show you of how this is done, in the community. All right, I think that gets us right to there. And apparently we have 1 minute left. I guess the slides aren't going to end, but I'm happy to answer any questions that you all have, or if you want to shoot me an email, you see my contact information right here and my phone number. I'm happy to catch up with you. So I guess I'll just hang out here, see if anyone has any questions. Otherwise, I appreciate you joining today, and thanks very much.
And I just wanted to let everyone know that the webinar is being recorded and that it will be online through the Preservation Alliance website as well as on our YouTube channel. So if you have any questions or just want to look at the slides again in more detail, because there was a lot of information presented, that will be available soon by the end of the day, probably. So one person's asked if the slides will be available separate from the audio. I can talk with William about that. We hadn't planned on it, but
I can send you the slides if you need me to.
okay. Yeah, maybe we can put those online somehow as well for people who just want to study the certain ones.
For sure. Yeah, I can email you that, and you could get them posted up.
Well, another minute here. Here comes another one. The latest question is, has there been any discussion about renewing new market tax credits by Congress as a result of COVID?
So right now the program is extended until the end of this year. So there's another application, or so there's an award that's going to be announced here in the next month or two, which is going to be more allocation available for CDEs that already applied last year. And then there's another application round that is going to be available in the fall that has been authorized and will be funded. Now, after that, so fall or summer, I should say fall of 2021, next year, that's the one that we're not sure about just yet because it hasn't been authorized beyond that time frame. But right now, there's enough allocation between existing CDEs who have allocation, the award that's going to be announced in the next month or so, and next year's award. We just don't know when the next application is going to open after the fall of 2021.
Okay, a couple more questions are still coming in. One is, any quirks when adding low income tax credits to watch out for?
Certainly. So when you combine low income historic tax credits and either historic tax credits or new markets, it can certainly be, it can certainly make things complex. Now, combining the historic and the certainly possible. We don't do it very typically, but when you structure it, if you have now I showed that lease structure before, but if you have a single tier low income structure where you don't have that lease in place and you just have the ownership directly with the owner, where the tax credit investor comes in at that level, then there's rules around them having to reduce their basis in the federal historic credits. Now, when you have a lease structure, if you have a lease structure in place, then the investor from the federal historic side and the low income side have different people. Now, that's kind of very like a vanilla answer to what's going on there. And then you can't combine low income and new markets in the sense that they can't be used to finance the same project. But if you have a project that has a low income component, you could condo that out and have a low income component and a new markets component on the commercial side. But again, that is definitely beyond kind of the scope of today's webinar, because that could probably take an hour just to explain in and of itself.
Another question is, how can we find a list of community development entities?
So that's published by the CDFI fund. So if you go on Google, type in CDFI fund, new markets tax credit, you'll pull up the page for the new markets tax credit. There's a page on there called like the QEI issuance report, I believe it's called. And that will show you a list of CDEs that currently have allocation and what they're trying to do with that allocation. So I didn't really get into this, but each CDE has their own kind of flavor or flair of what they like to do with their allocation. So in TCIC, we like to do historic projects in low-income communities and projects that have some type of jobs component. Some CDEs only do healthcare projects. Some CDEs only do projects in New York City. Like, it just depends. There's all different ones. And there's a West Virginia focused one, I believe, too. So that information is all publicly available. So go to the CDFI Fund's website, click on New Markets Tax Credit, and then click on, look up the QEI report, and you'll be able to pull all that information. Now, I did see one question here. Are you seeing opportunity zones being used in conjunction with NMTC and HC and certificate numbers? We've seen opportunity zone equity combined with new markets and historic equity. We've done it on a couple of projects now. It's not as, I guess, common as you see. Most of the time, it's kind of behind the scenes, I'll say, in that the opportunity zone, the developer was going to put money in the deal. It just so happens to be that it is in an opportunity zone, so they're putting their own money into it versus raising money from third-party opportunity zone funds that are then participating directly in the transaction. We've seen that. Happy to catch up with you offline if you want to discuss that further, if there's any specifics.
We have a couple more. This one is, would a historic school building be eligible or not because it is not an income producing property, or can the project turn into an income producing property, for example, apartments?
So I got the questions pulled up. I didn't see that one, but so the question is, if it's a historic school building, if it's occupied by a public school prior to the renovation and post renovation, it's still going to be occupied by the public school, then that's not going to work because it would violate the tax exempt use rule. Now, if it used to be a historic building, you renovated it and turned it into an income producing property, like you turned it into apartments or something like that, then that could qualify for historic tax credits.
I'm not sure if you see, there are two more. One is, can you combine opportunity funds and new market tax credits?
Yeah, I think I had touched on that one about the opportunity zone in conjunction with historic and new markets. So I think we should be good on that one. I did notice that two of them had asked that. So I think we should be good on that question.
Okay, and then does the National Trust provide a list of CPAs and or lawyers who can assist developers?
I can certainly provide a few names. Certainly there's some attorneys that are more focused on the investor side versus on the developer side. And there's certainly accountants out there that will work, certainly with smaller projects, bigger projects. Happy to connect in a couple of people so you can, talk through the specifics of your project. Happy to do that right there. You see my email on the last slide, wfiederlein@ntcic.com. Please don't hesitate to reach out.
Okay, great. I think that's everybody who has sent in a question. And like I said, we'll make this information available to everyone, and maybe, try to plan something in the future that goes into, more information. But if you have any questions or anything else, feel free to reach out at any time. And thank you all so much for participating. Have a wonderful day.
Thanks, everyone. I appreciate it.